Hi, this is Mike Maloney, and as promised in the last couple of videos, I have a precious metals expert here, and we're going to discuss the reason that, with all this turmoil going on in the world, people would think that gold and silver should be going up, but instead, gold and silver have been going down. And so this is one of the big questions that we've got. And so I have Ed Steer on the line here. Ed is formerly from Casey Research, and he had one of the most popular precious metals columns in the world called Ed Steer's Gold and Silver Daily. But now he's got his own website, edsteergoldandsilver.com, and he does daily commentary. I highly recommend going to edsteersgoldandsilver.com and checking it out. So, Ed, how are you doing?
I'm doing fine, Mike, and thanks very much for having me on your program.
Excellent. You know, right now in our precious metals dealership, GoldSilver.com, we're experiencing a mad rush for gold and silver, and volumes have just doubled. And what we're seeing is that shortages are starting to develop in many products. The U.S. Mint suspended Silver Eagle sales, and they won't be taking orders until August, and so we know that that pretty soon dealers are going to start running dry on Silver Eagles. There's not much supply out there, and the prices on precious metals on the physical starts to diverge. I know that I've seen the premiums that we have to pay for things like Silver Eagles and other products. They're all going up. We're getting charged quite a bit more than we were just last Tuesday. When they announced this, that's when it started to explode. And this is something that has happened in the past for us. Back in 2008 when the markets crashed, we saw something very similar. But I wanted to get your take on this because there are other forces at work here. And I would imagine that a rising gold price during a panic is a very bad signal when it comes to fiat currencies. What is your take?
Well, there's no question about it. The last thing that the powers that be in this world want right now is a precious metals price, any of the precious metals screaming to the upside in the face of what's going on with Greece and China. And as we've known for a long time, there's a huge dichotomy between what's actually going on in the physical market and what's going on in the paper market on the COMEX. You know, silver analyst Ted Butler, whose work I follow closely, has been always made the case, and is absolutely correct, of course, that a lot of the world's largest banks, principally J.P. Morgan Chase, are active in the futures market, and they can set the price of the commodity to whatever they want to, whether it be gold, silver, or platinum or palladium, and also the other two commodities involved are copper and crude oil at the same time. So, as you said, you know, the physical demand, which has certainly picked up in the last 2 weeks, because I've seen it at our own store, has certainly picked up a lot. But you'd never know by looking at the prices you're seeing on the COMEX for the last 2 weeks, because J.P. Morgan and the boys have engineered another classic engineered price decline in all these metals, and regardless of what the physical demand is, they can pretty much set the price wherever they want to. And right now we're at rock bottom, regardless of what the demand fundamentals are at the moment.
Yes, and when the price is so severely disconnected, when on the commodities exchange, the COMEX, when they're selling a bunch of futures into the market, it's for any of the listeners that don't already know this, they're basically making up fictitious gold. They're selling a paper contract that, well, it's actually an electronic contract that just specifies, I owe you so many ounces of gold in a future date with a strike price on it. And when that gets sold into the market, it's the same as selling real gold into that market. And that's what generates the global spot price, is the commodities exchange, the COMEX. And so the physical price follows this until they overdo it. When they are suppressing the price too much, what you see is a disconnect where shortages develop because the price is just too low. And it's been suppressed for a very long time, where it has suppressed production. A lot of the producers are having a very tough time of it right now, being able to dig up and refine gold and silver profitably. And so a lot of them have been mothballing mines, and there's been consolidations where there's mergers and so on. And so can you tell people anything about this process? And the main thing that it means to me is that gold and silver are on sale because they've been artificially suppressed, and that means that you can buy it cheaper than what it would be if the free market was allowed to work here. And the big opportunity is that no manipulation is successful forever. Every manipulation ends. The free market eventually builds up too many pressures and overwhelms the manipulation. So tell me your thoughts on all of those things that I just covered.
Okay, well, first off, there's no question about it. The price of the physical commodity right now, because it's been suppressed for so long, as far as silver is concerned, if you just look at the average inflation rate the United States government numbers put out, the average price of silver right now, based on its on the inflation rate, should be somewhere around $150 an ounce. So when you say that silver's on sale, it's the bargain of the century. There's just no metal out there that will touch it. And of course, the other metals are exactly the same way. And when the paper commodity, or the paper on the COMEX sets the price, when the international banking cartel sets the price for the precious metals, the miners, of course, can't make any money. And like you said, a lot of them either are consolidating or selling or closing down mines or whatever. And this certainly has an effect on production. And what happens, the worst of it is that the mining companies themselves are forced to high grade their mines, which means they have to change their mine plan and mine their most profitable, their highest grade ore, so they can make enough money just to make ends meet and leave all the rest of the stuff for higher prices. And I would say the entire mining community, especially the primary silver producers out there, have got their backs to the wall in this price environment. And it's only a matter of time before we see some of them go under. And there's been a couple of cases of small miners having gone under already. But the situation is so out of control now that supply or demand will certainly, our supply will certainly dictate the demand and will dictate the price one of these days, because there just isn't enough of it to go around. And that day of reckoning, in my opinion, is getting very close at hand with what we've seen in the last 2 or 3 weeks with the prices on the COMEX. They've taken them down to levels that when we see a rally off these lows, it'll be very interesting to see how high the prices are allowed to go. And if, as Ted Butler says, if J.P. Morgan and the rest of the banks don't step in front of the next rallies, well, we're going to see silver and gold prices that, quite frankly, will make your eyes glaze over.
Yeah, I've called them, that one day they will be called, instead of gold and silver, they'll be called unaffordium and unobtainium. But you mentioned high grading. People don't understand this concept. You have a vein that goes through a certain geologic structure, and that vein might be very dense in one area, and then it gets less and less dense as you move away from the vein, but there's still gold and silver there. And if you're high grading and just focusing on the core of that vein and getting the gold that's easiest to get out, when you come back later and try and get the rest of the gold that was left there because you couldn't afford to get it, the prices were too low to mine all of the gold out of there, the cost is incredibly high to come back and try and extract gold from an area that's already been high graded, right?
Oh, absolutely. There's no question about that, because what it does is the people, the geologists that run the mine have what's called a mine plan. They say, well, we're going to mine this block of ore. Let's say 4 grams a ton, and this block over here is 6.6 grams a ton. And there's veins through each one of these things, and what they end up doing is taking out the veins in the 4 gram per ton rock and in the 6 gram per ton rock, and they leave all of, like you said, they leave the remnants behind in the surrounding rock. That once they take out those higher grade veins, Well, it changes the entire structure of the mine internally below ground, and there's a limit at that point in time about how they can cut through the rock without having, things like mine cave-in and tunnel collapses and things like that. So it's very serious business when a mine is forced to high-grade its ore, because what it does is it decreases the life of mine from, let's say, if a mine is 12 years, got 12 years worth of gold in it, and you have to force to high-grade it for 3 years, well, it may cut the mine life down to 7 years. So this is not something that's very sustainable, and it's going to correct itself in the price sooner or later.
7 years, and then the output of the mine is half of what it would be, and then to go back and get the rest of the gold that's there would cost 100 times more, maybe, or 50 times more. Some incredible amount.
True enough, Mike, but the main point is here, it may not be physically, structurally possible to get the gold at all, because they would be forced to mine in ways that would make the entire underground structure of the mine unsafe to do so. And that's just as critical a factor as whether or not they can get the gold out of the rock at all, whether they can even get at the rock, because they may cause a cave-in somewhere else.
So that means that these low prices from the manipulation are actually causing less supply, not just now, but in the future. There's just going to be less gold that can eventually be mined, period. They'll never be able to get that gold.
True enough. That's true enough. The thing is that at the moment, because they're high-grading their mines, they're able to provide enough gold to meet the demand. The problem will come the moment that gold prices go up, even $200 or $300 or $400 or $500 an ounce. The first thing the mines are going to do is they're going to stop high-grading their mines, and they're going to go after the lowest grade possible where they can make money on. And you're going to go from, let's say, producing 2,500 tons of gold per year worldwide. It could drop down to 2,000 or 19 or 1,800 as they just stop high-grading their mines to go back to their original mine plan and take the cheapest gold they can get out of the ground and make a profit on it. That's what's going to happen. Right now, mining, the production is great, but the moment the prices go up, I can absolutely guarantee you that production will crater.
Wow. So tell me a little bit more about the factors of manipulation and, how that is causing gold and silver to, like right now we are seeing this rush, and we're seeing the price start to diverge, similar to what we saw back in 2008 when the markets crashed. Gold and silver started to crash with the market, but then well before gold bottomed in October of 2008, the price on the metals, the physical, turned around and actually started rising instead of following the spot price, which was still falling. The physical was going the opposite direction. And it was so difficult to get any supply during that period of time. Were you involved in this back then?
Yes, I've been working in the retail bullion trade for 4 years now, and I can tell you for most listeners, the supply chain for buying bullion from a wholesaler, it's a very long supply line, and the pipeline is very thin. And if there's any kind of excess demand at all of a sudden there's a lot of buying, and the mints only have so much product, they ship it out, and all of a sudden there is no more. And what they do have, they start hanging on to, and they start charging a premium for. So you can see the supply pipeline. I've seen it in some of these times where we've had screaming demand for silver and gold. I've seen the supply line empty out in less than a week, where everything was fine. You could buy whatever you wanted on Monday, buy whatever you wanted on Tuesday, and on Wednesday they're out of 10-ounce bars, and 4 hours later they call you up and say, we're not shipping anything for 4 weeks now. So I went through that. It's a very ugly scenario if you're a retail bullion salesman like we were, and these suppliers and the mints can turn ugly in a second if there's tons of demand and no supply. The premiums go through the roof, as you're more than aware. Yeah,
there was back in 2008. There was actually 3 days where we couldn't get anything, so we were pretty much out of business, and we could have filled hundreds and hundreds and hundreds of orders, or even thousands, if we could get something, but we couldn't. There just wasn't anything available. So, getting back to the banks, you were talking about, we talked very shortly before we started this interview, and you mentioned silver. So why don't we go to the silver manipulation, and you can tell us a little bit more about that.
Certainly, and be glad to. First of all, I want to state categorically that silver